What's up, fart sniffers and chip dippers? Welcome back to another week and another round of America playing Jenga with the economy, but they're blindfolded and only have 3 fingers. The government is about to shut down. The Fed's fighting over rate cuts currently, like it's Thanksgiving dinner, and someone just said that they're going to vote for Donald Trump in 2028. And Wall Street's just trying to figure out if Nike shoes are a big enough distraction to allow us to look away from the economy because it looks like it's a horse that just broke its leg and is about to go into the barn and get shot. So it is the final week of Q3 this week, folks, and the S&P and Dow all hit record highs. Now, one thing to note about this is everybody's asking, was this the top that we just saw? Or are we about to get one more sugar high before Powell rips the punch bowl away from all of us? Now, let's go ahead and start with Washington, because what's a weekly outlook without Congress threatening to torch the economy? Well, just for fun. Now, one thing to know is at 12:01 on Wednesday, unless Democrats and Republicans suddenly remember how to govern, the U.S. government, well, shuts down. That means federal workers furloughed, agencies will be frozen, and possibly no September jobs report on Friday as well, because nothing says sound economic management like turning off the lights before the payroll numbers come out. Markets usually shrug these things off because everyone assumes they'll find duct tape at the last minute. But here's the kicker. This time, the White House has floated actual layoffs instead of furloughs. Not see you after back pay, but pack up your desk, Greg, get out of here. Imagine being told your job is gone, not because of performance, but because Congress can't count past 10 without lobbyists holding their hand. And if it drags on, each month of the shutdown shaves off 0.4% of our GDP. That's not some doomsday blogger. That's Bloomberg economics. So yeah, markets may ignore the circus until the tent collapses and it's too late. Now, let's assume for a second that we actually get the jobs report Friday. Big if on that, by the way. Wall Street expects 43,000 new jobs, unemployment steady at 4.3%, and Oxford Economics is saying maybe 85,000, which sounds okay in theory, right? Until you remember, we used to print 200,000 plus jobs a month like clockwork. You know, like those kids who would make shoes in factories. So what's the risk here? If the number comes in hot, say north of 100K, the Fed hawks will scream, see, no more cuts. But if it comes in cold, like under 25K, then Powell's doves say cut faster and save the job market, Jimmy Jerome. Huh? But here's why it matters. This is the last jobs report before the Fed meets in October. Powell just told us there's no risk-free path. Translation, whether it's jobs or inflation, someone is getting screwed in this deal. And with Trump yelling for jumbo cuts while Goolsbee's muttering about stagflation, this report becomes ammo in the Fed's food fight. Investors here need to know which side loads the bigger gun, however. And if that wasn't messy enough, the Fed board itself is under legal siege. Lisa Cook, one of the few doves left, is still fighting Trump in court over her seat on the Fed. Former chairs Bernanke and Yellen even filed an amicus brief in her defense. Now, why does this matter? Because the Fed vote on cuts is razor thin right now. Cook staying means more caution, more measured cuts. Cook gone, replaced by another Fed pick. Suddenly, Miran's not the only lone kamikaze in the room. You'd have 2 or 3 voices screaming for slashing rates like it's Black Friday. Mind you, Miran wants to slash 200 points. Okay, so that shifts the balance completely, and markets absolutely will know it. Remember, the Fed already penciled in 2 more cuts this year, but 6 officials wanted none. Swap out Cook, and suddenly we're talking about deeper cuts on the table. It's not just legal drama, it's market moving drama. Now, earnings, we have a quiet week. Yes, it is a quiet week, but there are a couple names that matter, however. Nike is going to report on Wednesday, and it sounds boring, but Nike is a consumer barometer. If Nike says sales are soft, Wall Street hears the American consumer is finally tapped out. That's bad news because remember, consumer spending is 70% of GDP. Carnival Cruise Lines is also reporting, which, let's be honest, is basically a survey of how many people are willing to get norovirus in international waters just to feel like the economy is fine. And then finally, you've got Conagra and RMP. Not flashy, but staples. If food and home improvement sales drop, that's another sign consumers are tightening their belts. And not just because we're fat. Now, for every bear waving red flags, there's always a bull frothing at the mouth. Enter Brian Belsky at BMO, who just raised his S&P 500 target to 7,000. 7,000. I will say that again for the people in the back. His argument, well, Fed cuts, solid earnings, AI's not a bubble, volatility's fading, all signals of a secular bull market. He even said this might be a 1995-96 Goldilocks redux. Sure, except back when we didn't have Trump tariffs, trillion-dollar debt ceilings, or Elon Musk live streaming cage fights with his senators. But hey, maybe he's right. VIX is at 15, markets erase Trump's liberation losses in a month, and equities keep grinding higher. So yes, bulls are saying, chase this rally. The question is, are we chasing it into 1996 or 1999? You know, right before the dot-com bubble popped? So here's why this week matters. One, the shutdown could freeze data and stall the Fed. The jobs report could swing the rate cut debate. Lisa Cook's fate could literally change Fed policy. Nike's earnings could show whether the consumer is cracked. And all of this lands as Q3 closes and Q4 begins. The stretch run into the year end. Investors love certainty. This week, well, it offers absolutely none. Instead, we've got Washington chaos, Fed drama, and a market that still thinks AI will cure everything. So buckle up and put your strap on because whether you're bullish, bearish, or just exhausted, the only guarantee is volatility. Or as Powell would put it, no risk-free path. A couple announcements before we end the video. One, use the code CLOSINGBELL20 if you aren't a part of Investor Central Club to make sure you get 20% off your first month of service. This is a premium option service where you can find where the whales and where the big boys are actually buying options and what they're buying. Another thing, we will be starting a new segment on Trades and Gains where I will have more details, but we will have a very special guest who we will be speaking with once a week to go over basic economic reports and kind of break it down in a much more granular view, as if I was explaining to your grandmother how to set up her iPad. Anyways, I'm Max Pitts. This is your weekly outlook. Make sure you hit that like button, subscribe, turn on those bell notifications so you never miss a Trades and Gains market update, and I'll make sure to see you guys in the next episode. Have a great Sunday, everybody, and go Birds and go Lions.